What's up, T3 Live family? I hope you had a nice day today. The market moved up quite a bit the last couple of days. Hope you're taking advantage. I wanted to come on and share with you my favorite 3 or 4 gap patterns of all time. Today, every day, actually, every morning while doing the pre-market prep, I discuss my favorite gaps with the room. Today, I had students type in their favorite gaps, and I went over those with them before I finally revealed my favorite gaps, the favorite gaps for the day. And then in the coaching session after the close, we discussed the favorite professional gap patterns. And for those not in the black room, I thought I'd come on and share with you that info. We spent about an hour, or actually slightly more, in the coaching session discussing this. In this video, I only have a few minutes, so let's go ahead and get started. First, um, you have to understand that gaps create a lot of opportunities because they create momentum, right? And in trading, if you're a day trader, momentum is everything. Volatility is everything. If the stock doesn't move, you don't make money. So gaps create momentum, and excuse me, and it's like the saying, "Go where the oil is." Well, that's where the oil is. That's where the action is. So I like to focus on gaps most of the time, but there are a number of gaps every day, especially during earnings season, and knowing what gaps to focus on can mean the difference between making money and not making any at all. So let me go ahead and show you the 3 or 4 favorite types of gaps that I like. This is not actually a great example, but this is from today. That's why I'm showing it to you. The first gap, let's take out also a sticky note, is the gap that creates the gap or the transition A or C gap, or the gap that creates a transition A or C. What that means is, if you're not familiar with the 4 stages, the cycle um, through which all stocks move, it looks something like this, okay? Where you have a breakout, and that's called transition A, and then it goes into from stage 1 to stage 2, from stage 2 to stage 3. This is 3, 2, 1, and then it breaks down into stage, this is transition C, breaks down into stage 4, and the cycle repeats. Then you have 1, 2, 3. You can see the cycle on most stocks. Some uh, are easier to, I guess, to see it on than others, but you can pretty much find it on every single stock. Um, so the gap that creates a transition, that causes the stock to transition from, this is an uptrend, stage 3, and then this is stage 3 sideways to stage 4, the downtrend, is what I call the transition A or C, in this case C, gap down. The APOG, as you can see, didn't really go anywhere. I mean, it dropped a lot, rallied a lot, and then uh, it closed even on the day. But the reason why it didn't move very much is because it had already gapped to target, basically to support. Whereas something like the KFY, which was a swing call in the strategic swing trader last week, uh, that's the kind of gap that I like. It creates a transition C breakdown. So that's a beautiful gap, that gap just under the base, and because of that, it had the room to drop. The second type of gap is, let's go ahead and write it down, is the gap that ends long term, that ends the long-term trend. Up or down, doesn't really matter. So the gap that ends the long-term trend. An example of that would be the PRI, where the stock, as you can see, was in a long-term uptrend, and today it gapped down below the trend line, to end the long-term uptrend. If you're an institutional investor, that's how most probably institutional investors manage. If you read the book How I Made $2 Million in the Stock Market, where Nicholas Darvis discusses his box theory or how he managed trades, well, that's how he did it, by raising his stop to under support, under support. Every time the stock made a new high, he raised the stop. So when the stock finally breaks that trend line, most institutional money probably gets out of it. Okay, so PRI was an example. This didn't actually show up on the gaps list until later on, so I wasn't able to take advantage of it, but it's from today, so I wanted to show it to you. The MMC is another example. This I did trade, but it wouldn't drop in the morning because the market was so bullish. And you can see it ended a long-term uptrend. Now, this is not a very long-term uptrend. It's about a month old, maybe slightly more. A couple of better examples that I can show you, but they're pretty old, are the UTHR. See how it ended several months worth of rallying, and just under the 20 MA. Perfect, right? That's perfect. Better than the UTHR, which was basically perfect. Still better is when you have also shock value, Hasbro. So you have a long-term uptrend and gapped, and then you have also the green bars. The green bars are indicative that buyers stepped up and bought the stock, expecting it to do well on earnings, and then it reported poor numbers. So this kind of a gap is unbelievable. I mean, I short at the open and just go away for the day. The goal for a tier one gap is to stick with it until the end of the day, to close it at the end of the day, because they usually close at the lows, right? And again, in this case, it gapped under a long-term trend, but not only that, gapped just under the 20, under support, and has the shock value by gapping under the green bars. Okay? There's a firefighter right outside my house, so I'm getting a little distracted, but hopefully I have a noise canceling headset, so hopefully you're not having to hear the noise. At any rate, the siren. At any rate, that's the second type of a gap, the gap that ends a long-term uptrend. The third type is what? Is three would be the shock value gap. The shock value gap, right? The gap that creates shock value. An example of that would be CNAT today by gapping over a big red bar, uh, trapping traders. So anytime you have a gap over a big red bar, that creates shock value because every single person that shorted it yesterday and stayed short, and they all did stay short. How do I know? Because there's no bottoming tail. So it closed at the lows and the next day gapped up. So every single person got trapped. So today the expectation would be that it pops hard due to short covering. A better example actually would be the SONO from last week. The stock the day before had a wide range bar on pretty big volume, like 6 million shares, and closed at the highs just about, which again means that every single person, doesn't matter how smart they are, how professional, novice, big money, small money, dumb money, smart money, right? Does not matter. Every single trader that bought it and kept it was underwater the next day. And so when you go to sleep, your position is up nicely, and the next day you wake up and you're down 5,000, 10,000, 100,000, right? Depending on what size you have. Um, the the typical reaction to that would be to exit the position, especially since the stock starts to come in, starts to sell off as people exit, and it starts a snowball effect. As it drops, more people exit, and it continues dropping. This one wasn't the most perfect gap I've ever seen because it had a limited target. Support was right here, so it didn't drop very much, but it set up, which is great because it actually set up as a swing trade that I took and I called in the strategic swing trader program today. No, not today. The day before, I covered half yesterday, and then today I covered the back half. So a beautiful swing trade. So you can take advantage of it as a gap trade, and you can take advantage of it as a swing trade. If we go back to some of these gaps, I mean, look at how much the stock has been rallying lately, and it still hasn't even recovered from that gap. It's still not at 115. See this? And it's been rallying for nonstop for 4 months, 5 months, right? UTHR, I don't know if it's recovered or not. It hasn't. Look at this. It hasn't even recovered. And it's been 2 years. So you can definitely look to enter later on, especially if it sets up right after, because then the gap is still in effect or in control of the stock. There's a lot of people still trapped. And this setup as what we call a 1, 2, 3 pattern, where you have a wide range igniting bar, a narrow range bar, and then a breakdown bar. So this was actually a short right here. Stop right there and look at that sweet move. So this was a very, very nice trade. But at any rate, that's the third. Those are the three favorite gaps. Okay, those are the three favorite gaps. This is the coaching that we had today. So the gap that creates a transition A or C, the gap that ends a long-term uptrend or downtrend, the monster or mortgage gap, or in other words, the gap that creates shock value. Then there's a fourth type. It's not a favorite, but it's one of them. It's one of the best four. It's the gap that ignites a pattern, a buy setup or a breakout pattern. So from today, we have the CRC ignited or triggered a daily buy setup. Some might say, well, that's a W pattern. It's the same thing. It's a buy setup, right? With a retest play. And then the other one was the EEQ, which was even better because it gapped right up above that 220 MA and over a couple of red bars, creating a breakout. So the fourth type again is number four is the gap that ignites or triggers a pattern, triggers a buy setup or a breakout pattern. That, or obviously if it's a gap down, it triggers a sell setup or a breakdown pattern. The EEQ was especially good because it was also transition A, sort of, on the weekly chart. So this was really excellent as well. So those are my favorite gap patterns of all time. Um, if you are interested in trading gaps or learning more about gaps, I dropped a couple of links in the video description. Feel free to check them out. But that's about it for today. I hope you enjoyed today's video. Hope you have a great rest of the week, and I'll talk to you sometime soon. Take care, everybody.